Hey guys, Dave Keller with Market Misbehavior, and welcome to the latest episode of the Market Misbehavior podcast. Recently at the Orlando Money Show, I had the opportunity to sit down with Adrian Day. Adrian's the founder of Adrian Day Asset Management. He's originally from London, went to the London School of Economics, and has applied a lot of great experience in the field of economics to run a successful money management firm. He really focuses a lot of his attention outside the U.S. We had a really good discussion talking about all the different opportunities inside and outside the U.S., not just in equities, but how that relates to precious metals and, general other themes as well. I really enjoyed my conversation talking about top-down versus bottom-up investing, and I hope that helps you think about your own answer to that question, because I found a lot of times people tend to underappreciate one versus the other. We talked a lot about sort of the economic backdrop, whether or not the economy is as strong as some of the data might suggest, whether inflationary pressures are really behind us or still ahead of us, what the Fed in this upcoming and current rate cut cycle may mean for investors in late 2024 going into early 2025. We talked particularly about opportunities in gold and precious metals outside the U.S., and we ended with some ideas that he provided for areas of opportunity. And again, for a lot of U.S.-based investors, we've kind of been underweight and appreciating non-U.S. markets. And I thought Adrian's points on where maybe to focus our attention were very well described. So please enjoy my recent conversation with Adrian Day of Adrian Day Asset Management. Well, hello, everyone. Dave Keller here with Market Misbehavior. Pleasure to sit down with Adrian Day of Adrian Day Asset Management. Welcome to the show, and thanks for coming on the show today.
Well, thank you very much for having me.
No, it's a pleasure. So a lot to talk about, I feel like. In October of 2024, we've got elections, we've got macroeconomic themes that are emerging, we have a Fed rate cut cycle, we have the S&P and the NASDAQ making new all-time highs, and so forth. Give us a sense, sort of a high-level view of where your head is at, given the market conditions. Are you optimistic, given the strength that we've seen in the U.S.? Do you have reasons to be less optimistic, and why?
I'm certainly cautious, is the way I would put it. I'm cautious on the major global developed markets, not just the U.S., but the other major global markets, such as primarily Europe, but also Britain and Canada. Notice that I said Britain and Europe, two different places. Yeah. A lot of that is driven, frankly, by the valuations, and particularly in the U.S., the narrow breadth, the bad breadth.
Yeah.
One thing I should say, and I think it's important for people to realize, so when you're a money manager, and this is probably should be true for investors as well, but when you're managing money, you're not really in the business of making predictions. So you didn't, but a lot of people will say to me, where do you think the S&P is going? Where do you think this is going?
Yeah.
We're not in the business of making predictions. We're in the business of looking at risk and reward and trying to balance that. And so it's quite possible, I think, it's quite possible that the U.S. stock market continues to move up as we have a flood of new money. And I'm not just talking about Federal Reserve creating money. I'm talking about money pouring into 401ks that has to go into equity markets. Some goes into bond markets, but bond funds, but most goes into equity markets.
Right.
It's quite possible a year from now the market will be higher. But what is the risk is what I look at.
Right.
And I think the risk in many of the erstwhile leaders in the stock market is high.
Right, right. What does it mean for you in your portfolios to manage risk? How do you think about it? Is it through diversification? Is it through hedging? Is it just being aware of changing market conditions? How do you think about that?
Well, I'm a value investor.
Yeah.
And so I'm certainly not a market timer, but when you're a value investor, you sort of automatically become a market timer. If I can't find sufficient number of things to invest in that I think represent good value, then our cash holdings go up. And notice it starts from I can't find anything to invest. It doesn't start with I'm worried about the market, I'm going to raise cash. So right now we actually have higher percentage of cash in our global accounts, particularly the conservative ones, than I've had for probably 20 years.
No kidding. Okay.
Well, since the dot-com bubble, yeah.
Sure.
Now, when I say high, for conservative accounts, we're at about 18 to 20% cash, which, as you know, for someone who manages money, is considered very high.
A lot. Yep.
But I didn't start by saying, oh, I'm nervous, I'm going to raise money. And it's certainly not because I'm taking a vacation on the beach. When you can't find things you want to buy at good valuations, inevitably you raise cash.
Right.
The good thing, of course, now is that cash is going in short-term T-bills earning 5%.
Yeah, not bad.
And there's nothing wrong with that.
Tell me about your process a little more, if you could. Top-down versus bottom-up. Are you thinking more big-picture themes and allocations, more individual ideas, and they roll up to a broader bet? How do you think
that's
of it?
an excellent question. And I always like to say it's a little bit of both.
Okay.
I would say it's much more bottom-up.
Yeah.
But bottom-ups, again, as with the cash issue, it sort of becomes top-down. Because if I look at, let's say, an oil exploration company in Canada, and I think, boy, this is cheap, it's got a lot of projects, it's got this, it's got that, but then it's got debt and the banks aren't lending money to small oil companies, and this is hypothetical now, and well, the oil market's high and I'm nervous about it, then the top-down starts to affect what you think of the bottom-up. But I mean, we are bottom-up essentially, and some of the companies we bought have been, I'll say, very idiosyncratic, where the top-down doesn't really play into it much. But it always does. And, you know, Peter Lynch obviously was a great investor. I always hated when I was about to say I disagree with Peter Lynch. That's a dangerous thing to say. So let's not go there. Yeah. But when somebody says you're wasting time looking at the macro, I don't agree with that. I mean, if you think interest rates, if for example you were to have a contrary view and think that interest rates were going to suddenly turn around and start moving higher again, you would have to be in different markets and different asset classes than if you think interest rates are going, if you think the Fed's going to accelerate their move on the downside.
Yeah.
I think what Peter Lynch and what others like him was saying, in fairness, was more that it's unknowable.
Yeah.
You know, you could spend weeks and weeks and weeks trying to puzzle over the speed of interest rates, because I don't think the direction is in dispute. The speed of interest rates, and still not come to a proper conclusion. I think that's what they're saying. But clearly the macro effects. I mean, if interest rates start to move up sharply in the U.S., which they're not, and the dollar therefore responds and goes higher, well, you don't really want to be in gold in that environment.
Right.
So yeah.
When you think about inflation, I feel like not too long ago was a huge specter. It was a big challenge. Now all of a sudden the market's pricing in that it's a non-issue. Are you concerned about inflationary pressures going forward, or do you feel like we're ready to move on to the next?
Well, I disagree with the market on both. You know, after 2008, there was a 2008, 2009. A lot of people thought that we were going to have double-digit inflation in the near term, and I disagreed with that. But I certainly, rather than go over history, I certainly don't think that inflation is what's the word, squashed. We're certainly not in a situation that we were in 1980 after Paul Volcker, because Paul Volcker, as we know, first of all, there was much less debt in the U.S.
Sure.
But Paul Volcker, as we know, took interest rates way above the rate of inflation. And that didn't happen in the U.S. So when rates went up to 5, inflation was at, 8%. Now, of course, it's come down since then. But, you know, you look, whatever numbers you look at, I mean, you know, the PCE core, I think, is 2.7. Nobody that I talk to says that their costs only went up 2.7 last year. But anyway, but even at 2.7%, and I'm giving the absolute benefit of a doubt, because obviously if you look at CPI, it's higher than that. that's still meaningfully above their own target.
That's right. That's right.
It's above their own target. They picked a target, and they have not met that target.
Yeah.
And so, and they know that because Jerome Powell's messaging has changed from like 2 years ago. We're not going to change until we're at 2%. Yeah. Now, the last press conference was until we see a path to 2%. That's a completely different question.
It's a very different sentence right there, isn't it? Yeah.
So I'm not one of these people that think inflation is going to run away and we're going to have hyperinflation or anything like that.
Yeah.
But I think inflation's stubborn.
With the path that the Fed has taken in lowering rates, now the market pricing in at the November meeting a 25 basis point cut. What do you see about the pace of rate cuts going forward? How does that inform your positioning today?
Yeah. I mean, I think the market is a little optimistic, frankly.
Sure.
I'm not saying it couldn't happen. They're looking at, what, 3% next 12 months from now?
Yeah. Yeah.
I think that's optimistic.
Yeah.
Again, I'm not saying it can't happen, but I wouldn't call that my base case. To me, what's more important than whether it's 3% a year from now or whether it's still 4% a year from now is the direction.
Okay.
You know, if the direction is to lower rates and continue to lower rates, even at a cautious pace.
Right.
And Powell is fundamentally a cautious person.
Yep.
Then that's what's important for me.
Right. Right.
Yeah.
Okay.
Yeah.
Tell me a little bit about precious metals. Gold, in particular, has outperformed the S&P and the Nasdaq for most of 2024. Although a lot of people, I feel like, have ignored that reality. Given the rise that we've seen in gold and silver prices, do you still see further opportunity there, and why or why not?
No, absolutely. And on the panel, I made a joke that I'm going to use the four most dangerous words in the investment business, which are as different this time.
Yeah, right.
So what we've seen, as everybody knows, when you look at why gold has been going up for the last 2 years since the last bottom, you know, it went up, then it was in a trading range for a while, and then it took off 2 years ago. As everybody knows, the reason gold has moved up is because central banks have been buying gold. Chinese investors and savers have been buying gold. Those are the two largest demand components.
Yeah.
There are others. Saudi Arabians have been buying. Other Asian countries have been buying. But here's the critical point. The reason that the central banks have been buying, the reason Chinese consumers have been buying, is nothing to do with the macroeconomic environment, which is what normally drives gold.
Sure.
With the central banks, of course, it's the weaponization of the dollar and the desire to diversify their foreign exchanges away from dollar dominance. And so the reason people have been buying has got nothing to do with the normal reasons that gold takes off. And so that's why you've had this dichotomy where gold is moving up, but if you look at the Western investors, they've been selling. You look at the GLD, the largest gold ETF in the US, up until a month ago, that was getting almost daily consistent outflows. If you look at gold mutual funds, and I can talk from painful experience, 3 out of 4 days you were getting redemptions. That's not a gold bull market. And it was logical, because if you looked at the macroeconomic environment with high interest rates, seemingly low inflation, seemingly strong economy. I say seemingly because I disagree, but a strong economy, low inflation and declining inflation, a reasonably strong dollar, a strong stock market. That is precisely the environment where you don't want to buy gold stocks.
Right.
And so the market was not being illogical, even though gold was moving up.
Yeah.
But in my view, that's beginning to change. Obviously, with the Fed cutting rates for the first time, that's the biggest signal. And if you look back to every single time that the Fed has ended a rate hiking cycle. The first rate cut since after Volcker, since after that one, gold has moved up sharply.
Yep.
And that's what we're seeing now. So I think what we're seeing now is actually the beginning of what we might call a normal gold cycle.
Right.
And so now we're seeing gold, now we're seeing the GLD, the GDX, you're beginning to see inflows. Not huge, but you're beginning to see inflows as opposed to outflows. I think the GDX in the last 4 weeks had 40 million of inflows compared with 240 million of outflows for the last 3 months. Right. But it's turned. That's my point.
That's
it's
a change.
Turned.
Yeah. Tell me a little bit about your perspective on the economy. I feel like right now there's a big spectrum. This is one of those times where there are people saying it's very strong, people saying a recession is around the corner. Where are you on that spectrum and why? Yeah,
I'm definitely more on the negative camp.
Yeah.
The biggest statement I would make, and I'm not a socialist and a long way from a socialist, but the biggest point I would make is as we know, there is a huge dichotomy between the people at the bottom 50 or 40% in terms of assets and income, and the top 10%. And so if you look at the aggregate numbers are still good. Now we can dispute some of that, but the aggregate numbers are still reasonably good. Not manufacturing, but certainly employment, certainly GDP.
Yeah.
But for the bottom half of the people, they are now in a recession.
Right.
The bottom half is in a recession. You got credit card debt at what, 20-year highs, and credit card debt is pernicious because the average interest rate on credit cards is like 24%. But for lower credit people, they're charging 30 and even 33%. If you've got credit card debt, if you can't pay off your balance every month and you're paying 30% interest, that builds very, very, very quickly.
Yeah.
It's just an awful, vicious cycle. So anyway, the bottom half of the people are already in a recession, is my term. The other thing I would say, when you ask why, you look at all of the reports that come out, and the headline is good, and jobs, of course, is the classic. Unemployment's low, and new job creation. The last numbers we had, new job creation. Let's just look at new job creation for a second. As you and everybody else knows, 6 weeks ago, Bureau of Labor Statistics says, we overcounted new jobs last year by 818,000. 818,000. Now, I mean, it's just astonishing. How do you do that? When they came out last week with the great jobs numbers, as I'm sure you know, they revised, but a lot of people don't. They revised the last 2 months jobs upwards. They revised them upwards this time, but July's was increased by 36%. My point is, if you can overcount 818,000 jobs for last year, and then you do a revision, a 36% revision, how much confidence can we actually have in those numbers? That's the point I would raise.
Yeah.
And so if you look at employment, as you know, there's all these different employment reports. The household survey has certainly shown a less positive jobs market than the payroll survey. You look at last week, the ADP numbers were less than the government report. The ADP is private. The jobs report came out on a Friday. You look at the ISM survey. Now that's a survey.
Yep.
But you look at their jobs number was low. You look at the I've forgotten the name of it. The people that do the survey of business owners' hiring plans. And again, you have to look at what people do, not what they say.
Sure.
But if you look at businesses' hiring plans, they are 10-year lows now. So I think, and the other thing I will say, if you look at the jobs numbers, as you know, for the last year, the majority of new jobs created were government jobs. If you look at the last 12 months, we have had a loss in full-time private sector jobs. Most people don't know that. When you look at just the headline that comes out, 240,000 new jobs created, 260,000 new jobs created, it all sounds great. But if we are actually losing full-time private sector jobs, to me, that's not a healthy market.
Right. It's really, really helpful. Listen, one final question, Adrian. Talk to us about outside the U.S. exposure, because particularly I think a lot of U.S.-based investors are now very overweight U.S. because things have done so well. What's the argument to go outside the U.S., and what particular areas do you see opportunity going into next year?
Yeah, well, typically when you have inflation, not necessarily runaway inflation, but when you have inflation and when you have a declining dollar, and that typically goes along with declining interest rates, then smaller markets tend to do better.
Right.
And so we are focused now. I don't like to use the term emerging markets because, as you know, a lot of markets that used to be in the emerging category have sort of grown up. And,
they're sort of emerged now.
Yeah, and so when you look at the Morgan Stanley Capital International Emerging Market Index, it's markets that most U.S. brokers don't even let you invest in.
Right.
Like Saudi Arabia and Morocco. I mean, good luck trying to buy those stocks. So I use the term smaller markets.
Okay.
I mean, we had a huge exposure to Hong Kong. And just so it doesn't sound like I'm bragging, I'm not saying we've made money on it because we bought it a long time ago. But, the Hong Kong market, as you know, has turned in the space of a week.
Yeah.
It turned from a 52-week low to a 52-week high.
Very abrupt.
Just staggering.
Yep.
And I've actually been cutting back on that rally. But I think if you look ahead, if you look ahead a year or 2 years, I think Hong Kong Chinese stocks are going to do very well with the huge China risk.
Yeah.
Right? Huge China risk. But the potential there continues to be very strong. The stocks are remarkably undervalued. We have stuff in our portfolio that's trading at 10% of NAV. And these are Hong Kong stocks, not China stocks. So
right.
you can trust the numbers, and are trading at 4 times earnings and 2 times cash flow. I mean, just ridiculously cheap.
Right.
I like Singapore. Singapore obviously is a much more, stable market, a more responsible market, if you like. But we're getting we're seeing some very, very good value in Singapore. But Britain, I think the British market, obviously that's a mature market, a developed market.
Right.
But I think there's some very, very good value there. High dividend stocks and some takeover candidates there. So we've got quite a lot in Britain at the moment. Britain, Hong Kong, Singapore. And it's all very I think Turkey's a good market right now.
Right.
It's all very idiosyncratic, to be honest.
Got it. Adrian, I so enjoyed our conversation.
Thank you.
Can't thank you enough. Enjoy the rest of the show, and thanks for sitting down with us today.
Well, thank you very much for having me.
Appreciate it.
It was a pleasure meeting you.
Thank you.
Thank you.
For a lot of investors, I feel like economics and economic data can be a super overwhelming area of the markets because it's just so unfamiliar. And I thought someone like Adrian Day, what a refreshing and great just perspective on how to make sense of all the economic data, trying to understand the economic landscape, thinking about things like inflation, the Fed, the dollar, precious metals, U.S. versus non-U.S. markets, all through the lens of economics and money management. I particularly liked his comments about risk management. That is a question I love to ask everyone I interview. How do you think about risk management? What does it mean to you in the current market environment? I think investors, hopefully all of you, have much to learn from hearing someone like Adrian describing how he applies risk management techniques in his day-to-day process. I hope you enjoyed this recent episode of the Market Misbehavior podcast. As a reminder, all of our previous discussions with top strategists, money managers, and investors can be found on our YouTube channel. I'd love to know who else you think we should sit down with as part of this podcast series. So wherever you're watching us, make sure you drop a comment and let me know. For Market Misbehavior, I'm Dave Keller. And remember, it's always a good time to own good charts.